A trader needs to know how all markets move. In this video, I'm going to show you the most effective strategies I've found after years of trading multiple markets, so you can then specialize and focus on where you perform the best. So let's jump into the video, starting with stocks. This is the Tesla stock on the daily chart. On this strategy for stocks, we start from the daily chart because it's easier to mark the last day's high and the last day's low. Now what we want to do after marking these zones is to zoom into the price action to observe if a breakout would happen. And we want to pay attention to the exact moment of the breakout. The 15-minute time frame is great for this step. It has a combination of being higher enough to see the macro price movements, while also low enough to view the more detailed price movements on a low time frame. And here we see that we are closer to the last day low, so there might be a higher chance that we see a break of the lows. But we don't want to predict a breakout, we just wait for it and follow it after. And it truly looks like it broke the last day low. Also closed below the range with a bearish candle. So we would be looking for selling setups. But for that, we are going to zoom into a lower time frame once again. This allows to get the highest quality setup we can get, because we can see all the price movements and not only the important ones. Usually I'd go for the 1-minute time frame, but the 5-minute works just as well. And what we see here is that price broke down below the last day low, started pulling back up, and now on the recent price action, the market has retested the lows. Now there are two options. The market could break out above these highs, pull back down forming a higher low, and then forming an uptrend structure. In this case, we would not trade this setup because it will invalidate the sell setup. And the favorable option for selling positions would be for the price to form lower lows on this internal structure, then move back up, but failing to break the highs, which in itself forms a bearish pattern. And it looks like this might be happening because notice how the last candles started wicking to the upside but instantly rejected back down by also closing bearish candles. This shows that sellers have more strength than buyers. So now, respecting the strategy, I will place a sell position right after the bearish candle closes, with the stop loss above the recent internal highs, and take profit at around 1 to 2 risk to reward. So let's review the strategy step by step on a simple presentation. We start by going into the daily time frame of a stock. We mark the previous day's high and the previous day's low. Then we zoom into the 15-minute, 5 minutes, or 1-minute time frame to clearly observe the moment of the breakout. If the market does not break out on that day, we have two options. The safest one is to simply just not trade that day. This strategy is not met on a daily basis. However, it works great, and I've found it to super effective for me. This is great also for beginner traders, or traders just getting into trading stocks. So as I said, we have two options, and one of the options is to cancel the plan for that day and look for the same opportunity in another day. The other option is to actually trade the setup anyway, even if it breaks out of the highs or lows in another day. This lowers the quality of the setup, but increases the frequency of opportunity. In my opinion, it's still all right if we trade a breakout that happens about 1 to 2 later than it should. So anyway, let's hypothetically say that the market will break out eventually. It can break out on two ways. If it breaks the high, we zoom into the 5 or 1-minute chart right after the breakout, and we look for retest of the broken high. We will be looking for a buy setup only after we see a candle that reacts by bouncing up. The most optimal scenario would be if the market would print a large full-body candle closing above the highs of the previous candles from the left. If that happens, we buy the stock. The take profit should be above the highs that just formed, to basically form higher highs. And the stop loss is placed to in such a way to have an at least 1 to 2 risk to reward ratio, or 1 to 3, but I would not go above that on stock trading. And on the other scenario where the market would break the previous day low, we basically do the exact opposite. But first, right after the breakout, we zoom into the 5-minute or 1-minute time frame, and we wait for the price to pull back into the previous day lows that just broke down. Moment where we don't just sell immediately, but we wait for a large bearish candle with a fuller body to form. This candle, in an optimal scenario, should take out the lows from the candles situated right on the left. And after that candle loose, we can sell short this stock with the take profit below the lows. The plan being to follow the market into forming lower lows, and the stop loss placement where it makes a 1 to 2 or 1 to 3 risk to reward ratio. And again, I would not target more than that on stocks. And that's basically it. This is the simplest strategy I've found to be working great on stocks. It's super simple and kind of mechanical, step by step. Now let's run some more tests on more stocks applying this strategy. This is the Amazon stock on the daily time frame. We mark the last day high, and we mark the last day low. Now let's try zooming into the 5-minute time frame. It doesn't make much a big difference. We can take it as more intraday trade as well as a scalp setup. And the next day opens up above the highs, so it basically broke out the last day high during the pre-market. Now what we would look for is a retest of the last day high, and we have it right here, where we can also meet downside wicks that reject back to the upside, so opposite to what we've met on the last setup. This indicates that buyers have more strength than sellers, and sellers are not able to take control over the market. We can now place the buy setup on the close of the bullish candle, basically exactly the opposite of the last setup. So stop loss below the recent lows. Take profit at around 1 to 2 risk reward. And this was a very quick trade. This is why it's very helpful to properly read candles. The candle structure was just very bullish. On the eBay stock, we start from marking the last day high and last day low on the daily time frame. Then we zoom into a lower time frame, either the 15-minute or the 5-minute or even the 1-minute. This is to view the break. So here it looked like the market has a pretty high chance of opening below the lows, since the market closed right at the day low. And it actually did, as expected, which was then followed by a pullback to the last day low, basically retesting the zone. And we look for a bearish confirmation, which could be right this candle that looks like it retested and rejected back down. So placing a sell short at the close of that candle, with a stop loss above the recent highs, with a take profit at around 1 to 2 risk to reward. This closed as a win in 15 minutes. Sometimes it literally can be this simple as long as it's easy to properly identify the candlestick momentum. Setups like this one are actually pretty rare. Usually it gets more complicated. Now into the Forex market. Here things start to get more complex because we need simple market structure, but as well as pretty advanced market structure. We need to be able to identify liquidity, and economic news also play a huge factor in here. So let's start from the beginning. Forex allows great setups for all types of trading, be it scalping, intraday trading, swing trading. All can be done in here because the Forex market is highly liquid. Now before going into another backtest, I will explain the trading plan on a simple presentation. This way more people can understand the process step by step. So the first thing when getting into the charts is to analyze the market structure. That simply just means that we need to identify where the market has been moving recently. And our plan as traders is just to follow that certain trend. Now the way to analyze a trend is by understanding the swing level formations. If a market looks to be increasing over time, on a candlestick chart the price will be presented with a sequence of multiple bullish candles that move to the upside, then a sequence of bearish candles that move the market to the downside. These two moves represent two potential swing levels. The swing high is the level where the price has reached its highest local price before starting to move down. And if the market starts the upside momentum once again, this validates a swing low. A swing low is the lowest price that has been hit on that structural level before starting to move to the upside. The uptrend is confirmed once the market moves to the upside and breaks up the last swing high. Now after a break of swing highs, we get what we call a bullish break of structure. And that just means that the market has broke the last price structure and has entered into a new price structure. But this also shows that the market is likely to continue to the upside. And this process repeats, the uptrend being held as long as we have a swing low that is higher than the previous swing low. That basically means that we get higher lows, while also having the market breaking into higher highs. And in this type of market structure, we are going to plan buy setups. But we'll get into setup planning soon. Now, just like on stocks where we had support and resistance mostly as an entry structure to trade from, on Forex we have what we call supply and demand. They're a similar concept to support and resistance, but they're not the same. On uptrends where we have higher highs and higher lows, we are going to use demand zones. And now the question is, what are demand zones? Well, they're simply just the last candle that pushed to the downside. Right before having the market to continue the uptrend, the demand zone is taken from that candle's higher wick to the lower wick, so basically the entire candle wick and body is the demand zone. The theory of the demand is that large traders, especially those working for institutions, so traders with large-sized orders, they often do not enter 100% of the position in just one order, but they open their trades in batch orders so the market keeps its balance of liquidity. The downside movement that happens right before pushing up shows that they move the market intentionally lower for their buy orders to be placed a lower price, so getting a better entry. Just for later, for their orders to get filled on the market, and that is what causes this large continuation into higher highs. So another break of structure. Now after a continuation phase, we often enter a pullback phase. On the pullback phase, the market slowly goes down to gather more liquidity. The market is always looking to be efficient and to balance out orders, and it does so by moving slowly from where it came from. And this is where the demand zone plays in, because you will see a lot of times that the market pulls back into the demand zone, and then it rejects back up from it, eventually pushing the price into trend continuation. The theory is that those same large traders have their large pending orders near the demand zone, so they could be opening another batch of trades there, and this causes again a large price swing to the upside. Price swing that again moves into higher highs, formed higher lows because it is not broken down below the swing lows, and we also get the bullish break of structure. So this is the whole process for uptrend markets in Forex, and where we would look for buying setups is on the demand zone, as long as the market keeps repeating the same structure. All we need to do is to place buy long positions on the upcoming demands, with stop loss below the demand, and take profit above the swing high, because we are looking for higher highs. But also be careful, because if the risk-to-reward ratio is too large, you could get stopped out easily. In my opinion, I've found 1 to 2 risk-to-reward and 1 to 4 to be the ones working best. Sometimes you can get higher ratios, but they're more rarely met. Now what happens when the market fails to hold this trend, and instead of forming a higher low, it breaks down below the lows? Well, the breaking of swing lows in an uptrend is called a market structure shift. We mark the shift from the previous structural low to the recent low that just broke down below it. This market structure shift just indicates that the market has a high probability of trend reversal from an uptrend into a downtrend, but only a probability, because the confirmation itself comes after the market moves up, but fails to break the last swing high, and instead it starts to pull back significantly. And this forms a lower high, to eventually break down the lows again. Now the break of lows in a downtrend is considered a bearish break of structure, and now is when the supply theory comes in. Similar to the demand, the theory is basically the same, just to the other side. If on the demand those large traders were buying the market near the swing lows, on supply zones those large traders are looking to sell the market near the swing highs, and the supply zone is the last upside candle before the trend starts again moving to the downside. And because the market looks to rebalance itself, it might look to pull back to the upside. Now you will also see this happening a lot when the price hits the supply. The market rejects back down and continues the downtrend. So our entry structure on downtrends is the supply zone, and the setup positioning is taken with a sell short on the supply, with the stop loss above the supply, and take profit below the swing lows. Now here also, if the risk to reward gets too high, I would close the position earlier. So basically looking for a 1 to 2 or 1 to 4 risk to reward. Now there was also the option to apply this setup right after the market structure shift. There isn't a set in stone rule. Some find better setups on the first supply, some find better on the second supply, so you might test yourself many trades and see what works better for you. But also keep in mind that the supply or demand zones do not always form. Sometimes the price just starts going down before hitting the supply, or the price starts going up before hitting the demand. This type of setup requires more patience, so you probably won't trade on a daily basis using this as a swing trader. You might as a scalper, but this is more targeted for swing traders. Because for scalping, there are some more concepts to be applied, like the top-down time frame analysis and so on. But in this video, I want to keep it as simple as possible. So let's check it up on the charts. On the first view of this market, it looks like it's slowly going down. So let's analyze each important structure to make sure we get the levels right. At the start, we got a small upside move that forms a local high, but then fails to hold the uptrend and continues to dump back down. We then get another small upside movement. This is representative as a pullback that sets a local high and starts dumping again, basically breaking down the last lows. So we mark the lower lows and we mark the lower highs. Then we see that the market has done the same kind of movement. Each break of the lows that basically continue the downtrend is called a break of structure. The break of structure is just a reminder for us to see on the chart that the trend has continued. But now here, the price shot up very aggressively, and actually it broke above the last lower high. This is what we call being as a market structure shift. But then this trend reversal did not confirm, shortly after breaking the highs. The market formed equal highs, a sign that buyers did not have enough strength to keep up the buying pressure, and that formed a double top. On double tops and equal highs, we know that there is resting liquidity above. And this is important because the market tends to move towards liquidity. Then, after rejecting to continue to the upside, it instead broke down below the internal lows. What we actually wanted to see for buying setups is the push that we got, but then followed by a pullback, and finally a break of the last highs. This break forming a break of structure, and in that case we would look for a demand zone near the lows in order to take the market into new highs with a buy position. But this did not happen, and instead the uptrend failed to hold, with the price forming in another lower low. But right after we've got another upside impulse that is followed by a small downside pullback. Now this formation actually sets in a higher low, together with a higher high moment from where the same structure prints again. So we got a sequence of higher lows, with their higher highs being broken up. And this time it also broke up above the swing high for the second time, basically forming again the market structure shift. It rarely happens to form two fakeouts in a row, so this has a higher chance of respecting. Now what we would be looking at is a continuation of the uptrend, basically expecting a similar type of movement formed with a pullback, a break of the highs, a pullback, and break of the highs, and so on. And we will be looking at demand zones near the higher lows to buy at the best price we can. Now in this specific price action, the last demand would be this one. Right now we have the price approaching it. On demand zones, we look for buy setups on the top of the demand, with the stop loss below the demand or below the lows. In this case, they both respect, and the take profit above the highs, or when we get a 1 to 2 or 1 to 3 risk to reward. Sometimes we can target even more depending on the setup, but that's more rarely met. This last candle triggered the buy order on the hit of the demand, and it near instantly rejected back up, with the couple next candles holding the bullish momentum, and eventually closes with a take profit. The logic was to target a break of structure by just following the trend. Alright, let's get into the next one. This time on the GBP against the US dollar. This is the 4-hour chart. What we see here is a descending price action, basically a downtrending market, from where we got a local high formed, level from where the market started dumping back down, breaking down below the last lows, which forms a market structure shift towards the bearish side. This bearish trend is of course backed up with a continuous formation of lower lows and lower highs, up until it also formed the local low, level from where the market started climbing slowly back up. This upside momentum gets to break the last lower high. So this is once again a market structure shift, but this from flipping the market from a bearish trend into a bullish one. And this time, it looks like the market shift has respected. Notice the higher high with a pullback to the downside. This pullback ends higher than the last one, and that simply means that we got a higher low. And of course, because of the break of the high that caused the market structure shift, we've also got the higher high formation. A combination of both higher lows with higher highs is seen on uptrends. That is the characteristic movement of an uptrend. A continuous formation of higher highs, with higher lows. Now because the market broke the last high during an uptrend, we've got the first bullish break of structure. From where the market continues, the uptrend pushing to the upside. Now getting in the recent price action, on uptrends what we would look for are demand zones to buy from and take the market into new highs. But that does not mean that the market must always hit the demand zone. Sometimes it still breaks to the highs, but it does so before hitting the demand. And that is basically what happened right here on the chart. Notice that the market did not fill the demand, but the pullback ended above the demand, and the market continued the trend after, basically missing a winning setup. In cases like this one, we have two options. We can simply just skip to the next opportunity, or we can implement fair value gaps. We are going to talk about fair value gaps on the futures and indices if you don't know it yet. But we can see that the market pulled into this fair value gap, filled the inefficiency, and continued the uptrend. Now we can look of there is another one because the demand failed to fill, and on the next pullback there is another gap situated here, from where once again the market filled it and continued the uptrend. The setup planning on fair value gaps is similar to the demand and supply zones. Entry on the gap, stop loss below the gap if you're looking for a scalp, or below the lows for a more swing type of trade, and take profit above the highs, or at a decently high risk to reward. On the US dollar against the Japanese yen, on the 1-hour time frame, at the first sight we see a descending price action, so let's analyze what's going on in order to find an opportunity for a setup. So here on the internal levels, we see an uptrending market, the uptrend that has the characteristics of higher highs and higher lows, and the formation repeats up until the price starts pulling back down slowly, with an increase in selling pressure. This move breaks down below the last higher low, thus forming a lower low. On an uptrend that breaks down the higher low, we get a market structure shift that basically shows a high chance of a trend reversal from an uptrend into a downtrend. After any kind of break of structure or structure shift, we expect a pullback phase, which is this movement. Then after the pullback, the market enters into continuation. And a continuation on a downtrend is a break of the last lows. Now here, the price pushed up above the last highs. Normally, this would also be a structure shift, but to validate the shift the market would have needed to pull back down, which it did. But then it should have broken above the highs to at least form the first break of structure, but it did not break, but instead it formed a lower high. So we don't have any signs of a reversal into a bullish market, but instead we have more and more signs that this market is very bearish and is likely to continue to hold this trend for a while. Now, if we also check why did this market pushed into these highs recently, that is because there was a supply zone. Just as expected, the market moved into the supply and rejected back down into forming new lows. This was the planning of the setup. That would have closed as a win. But the last downside move also has formed a supply here, so we can plan again another similar setup. And closes as a win with a 1-3. Probably could have squeezed a higher risk to reward, but in my opinion, 1-3 is more than enough. And if we zoom out, we can just look at the whole simple logic of this strategy, and that is to simply just follow the trend. If the market has constant lower highs, we look for supply zones near there, and look to target the price into lower lows. The next market is the futures market, and more specifically the futures of indices like the ES and the NQ, these two being the most popular trading indices, has many similarities with Forex. We need the same concepts: market structure and price action. On indices, liquidity hunts are less rare than in Forex, but they can still be met. So on the futures market, the volatility starts when the US session open starts. It's more volatile in the first 2 hours of the market, and volatility starts to drop until the US session closes. Trading the pre-market is not that great on indices futures because of very slow movements with decreased volatility. So what we want to do is to analyze the market before the US session starts. The analysis is very similar to what we did on Forex. It's mostly about understanding whatever the market is right now in an uptrend or in a downtrend. But here on indices, instead of using supply and demand zones, we use fair value gaps. Fair value gaps are also called imbalances or inefficiencies. And without getting into deeper details on the theory, you can view them similarly to supply and demand zones as in their impact. The only difference is their placement or where they are situated. Fair value gaps are found on a sequence of candles. If the candles are bullish, and there is a candle near the middle of the sequence that is much larger than its near candles, there is a high probability that a fair value gap is found there. The fair value gap on a bullish scenario is found from the previous candle to the large one, and it's taken from its upper wick, and we connect it with the lower wick of the candle next to the large one. So if we find this type of setup before US session open, there is a high probability the market would fill the imbalance and continue the trend. In this case, we could place a buy long on the fair value gap, with a stop loss below the gap, or even safer below the swing low, depending on your personal choice. And with the take profit near the swing highs, or at a decently high risk to reward ratio, And if we get into the charts and identify a downtrend before the session open, we look for a bearish fair value gap. A bearish value gap is found between a sequence of bearish candles, where we would find a large candle near the middle. The bearish fair value gap is taken from the lower wick of the candle previous to the large one, connected with the upper wick of the candle next to the large one, and this entire zone is the bearish imbalance. Now we would look for sell-short setups when the price fills the imbalance, with the stop loss above the imbalance, or if you prefer a safer placement, it would be above the swing highs, with the take profit below the swing lows, or at a decently high risk to reward ratio. Of course, without being too greedy. This is the Nasdaq on the 4-hour time frame. At the first view of this market, we're able to see an uptrending market that steadily goes up. The important structures start from around this price range, where the market broke up above the highs as a continuation of the uptrend. So we basically got a higher low with a higher high. Then we got another push that sets in the local high from where the market started selling off aggressively. This sell-off breaks the price down below the last swing higher lows. So we got a bearish market structure shift, and because this likely flipped the trend from an uptrend into a downtrend, we will be looking at fair value gaps to sell from. Now here we have these very large candles. It's quite common for these large candles to have inefficiencies in form of fair value gaps. By simply applying the theory, so this is the large candle from the middle of the candle sequence. Then we take the candle from before, and this is our first candle, and then we take candle next to the large one, which is this one. And this is the third candle. And the fair value gap is taken from the first candle's lower wick to the third's candle upper wick. And this is the bearish fair value gap. Now we can plan the setup, sell short on the gap, stop loss above the gap, and take profit below the lows, or at decent risk to reward, not too high but also not too small of a ratio. We got the position triggered, and shortly after it continues the downside movement, closing the position. On the S&P, we see a similar price action. There are essentially the same dates, and as you know, the S&P has a great correlation with the Nasdaq, especially when it comes to more swing type of trades, because on the lower intraday time frames, it doesn't correlate as well as it does on the higher time frames. So we essentially got an upwards momentum that is soon faded out with the market selling off to the downside. This sell-off breaks down below the swing lows, which forms the bearish market structure shift. Now what we would want a pullback to the upside where we look for selling setups and taking the market into new lows by just following the recently formed downtrend. Now in here we have another type of fair value gap, and this is specifically seen on markets that close overnight. The zone between the close and the open of the next trading day forms a gap. The market often fills that gap and rejects to the opposite direction from the movement that initially has filled the gap. In this scenario, it would be a rejection to the downside. In that case, we open a sell-short position on the gap, with multiple options for the targets. One can be with the stop loss above the gap and a take profit at around 1 to 2 or 1 to 3 risk to reward, this being a more short-term trade setup. And the other option would be for the stop loss to be placed above the highs and the take profit below the lows, or at around 1 to 2 or 1 to 3 risk to reward. If you were targeting a 1 to 3 short-term trade, the position would still be running on this day. If you were targeting a 1 to 2 short-term trade, the position would have closed as a win. And if you were targeting the swing trade, the position would still be running. Unfortunately, I can't go further on this chart. This is the 31st of January on the S&P on the 4-hour chart. So maybe viewers in the near future can see how each setup would have played out. Actually, I decided to post this video later on, and these are the results of the setups. So for the 1 to 3 scalp, it closes as a loss, and for the 1 to 2 swing trade, the position closes as a win. On crypto, this is how the most effective strategy looks like, and it works great on Bitcoin specifically, but it can work on high-cap altcoins just as well. This happened already, so I will just show the steps and how it would look like on the charts, because we've already talked about the planning before. So on a higher time frame, more specifically, on a 4-hour time frame, we look for a consolidation, basically a market that is moving sideways, and we mark the support, and we mark the resistance. Then we wait for the market to break out from one way. In this scenario, Bitcoin broke up the resistance. Then we would want a pullback of the resistance. This flips the resistance into a support, and we buy long on the closure of the most bullish candle that first bounced up from the flip support. On Bitcoin, we want more swing type of trades. I personally perform much better swing trading on Bitcoin rather than scalping it. So on swing trades, the target levels are more distanced from the entry. The stop loss is usually placed opposite to the level that it broke, so right below the past support, and take profit at around 1 to 2 risk to reward, and this closed as win. Now we can also check later on the most recent price action. We basically have the same pattern forming in again. So we got the support down here, and the resistance up here. We have two options. The market breaks out the resistance, retests the zone and starts going up. And in this case, we would look for buy longs on a bullish candle close, with the stop loss below the past support, and take profit at around 1 to 2 risk reward. The other option is if the market breaks down the support, retests it flipping it into a resistance, from where it starts to continue the downside movement. Moment where we could look for sell short setups on a bearish candle close, with the stop loss above the past resistance, and take profit at 1 to 2 risk reward. Now I actually came back later a couple hours from when I recorded, and it looks like scenario 2 is playing out, since the market broke down the support. Now what we would look for is a pullback to the upside and a continuation towards the downside. Keep in mind these targets for the future viewers, and take a look at the result of this position. Now that was it for this video. After years of trying out strategies, these are the ones I've found to be the most effective. They have a great mix of simplicity, not being too complex while also working out great in the long run. But at some point, they will start to underperform and new strategies will come up. It's truly mostly about market psychology and the way traders think. With a great trading mind, you can implement new systems. It's why I focus a lot on psychology. You have my ebook on the link in the description. It mainly focuses on how to stop destructive trading so you can survive in the trading game. The ones that will see the most success are the ones that can hold a sustainable trading approach. If you liked the video, feel free to leave a like, and also don't forget to also check out the community tab here on YouTube, where I post unique and useful details. Thank you for watching.